Hi everybody, today I'm going to provide you an update on my stocks and unit trust portfolio. I'm also going to elaborate more on the 10 US stocks that are currently in my portfolio and what is my plan going forward. This is an overview of my 10 Singapore stocks and 10 US stocks portfolio. And you can see that most of them are currently in the red and the stocks losses is more than 3,000 Sing dollars. First, let's talk about what are the changes on my portfolio since my last update in August. For the Singapore stock side, I have added in CapitaLand Invest, Comfort Delgro, SGX, ST Engineering. And I also have averaged in sets after they have announced they are going to acquire WFS, and with equity fundraising will cause the share price to drop more than 20%. For the US stocks portfolio, I have added in Google and Realty Income. And on top of that, actually, I have averaged in Visa, Apple, and Microsoft. Let's look at the dividend I collected since I started this portfolio from January. Total dividend collected in Sing dollar term is $245.07. And every month, I have diligently earned $4,000, one around beginning of the month and one is around middle of the month. Total value I've added into the portfolio is $41,000. I've targeted to top up $50,000 every year to this portfolio. So I got 9 more thousand to top up towards the end of the year. And next year I'll top up another 50,000. The current market value is 38,178 cents. And the profit and loss will include the dividend collected and also the interest I earned from money market fund. So the total losses is slightly less than $3,000 and we equate to about 7% loss. And now let's look at my unit trust portfolio. My unit trust portfolio currently have 6 funds and all are in the red now. And year to date, the return for this portfolio is negative 19.35%. That means it suffered a loss of slightly less than 20%. And for this unit trust portfolio, I do a dollar cost averaging RSP of $2,000 on the first week of every month. And along the way, I also make some ad hoc top up. So currently, the total portfolio invested amount is 28,700, but the market value is 24,413. So this equates down to a loss of 4,002 and a loss of 14.94%. For the unit trust portfolio, I will increase the frequency of ad hoc top up until end of the year. Now let's go into the 10 US stocks that are currently in the portfolio. I will rank them in terms of market cap. So the first US stocks in my portfolio have the highest market cap is Apple. Apple have a market cap of 2.3 trillion US dollars. And the trailing 12-month gross margin is 41.78%, and the net margin is 25.88%. The P for Apple is 23.69. And let's look at the earnings and revenue for Apple since 2004. From this table, you can see that the earnings for Apple have been increasing every year since 2004 until today, despite the COVID pandemic. This is an analyst estimate, and you can see that Apple so far since 2014 to 2021, and on an annual basis, they have constantly given surprise. That means they constantly beat the analyst estimates on a year-on-year basis. Their revenue have been increasing year-on-year. They have either beat the analyst forecast or on par with the analyst forecast. From the forecast, we can see that the earnings for Apple are supposed to continue to grow for the next few years, including the revenue side. A lot of investors may not be aware, Apple actually is a dividend growth stock. This is the dividend history of Apple since 2015 to 2021. Apple dividend growth from 0.49 to 0.85 over the past 6 years, and the dividend actually increased by slightly less than 100%. But because of the Apple share price have been moving so high, which resulted in their dividend yield at actually very, very low, not even 1% currently. And also the payout ratio is very, very low. A lot of investors invest for Apple, they are mainly looking at capital appreciation rather than dividend. Let's look at Apple performance year to date. It have down 17%. in line with S&P, which is also down double digit. But if you are holding Apple for the past 5 years, despite the current market downturn, you are still making 275% profits. And if you were to add in the dividends, which is not a lot, but you'll be surprised that your profit increased by additional 20%. It's become 295%. Now let's move on to my second stocks, which is Microsoft, which is a software company. And the market cap for Microsoft is 1.76 billion. They have a gross margin of 68%, and their net margin is 36.69%. We show that it's a very, very profitable company. And their PE ratio is 24.48. Their dividend yield is much better than Apple, but it's still on a very low side of 1.05%. Let's look at their earnings. Despite the COVID pandemic, we have seen that their earnings increase year on year. And most of the time, except 2022, their result is better than analysts estimate. Their revenues also increase on a year-on-year basis. And it has been forecast that their EPS and their revenue will continue to grow for the next few years. Let's look at the dividend per share for Microsoft. They have been increasing from 2016 at 1.44 cent to 2.48 cent. Similar to Apple, their dividend has increased at close to 100% over the past 6 years. However, their dividend yield have been dropping due to their earning increase, and we can see that their payout ratio actually is dropping year on year, despite their dividend is increasing year on year. This shows that the company is earning more and more money and more profitable over time. Let's look at the share performance of Microsoft. It have underperformed S&P 500 year to date, where Microsoft had down 27%. And however, if you were to hold Microsoft over the past 5 years, for those long-term investors, even at this current market juncture, you're still making 200% profits. And with the dividend included in, you make an additional 20% profit, which is 226%. The third company, which also has a market cap of more than $1 trillion US, is Google. You have a market cap of $1.3 trillion and a gross profit margin of 56.91%. with a net margin of close to 30%. And their PE ratio is 18.71%, which is much lower compared to Microsoft and Apple. Let's look at their earnings. The earnings per share for Google have been increasing year on year from 2014 at 1.29 to 2021 at 5.61. Although the analysts predict that there will be a drop in their 2022 earnings, ultimately long-term wise, they are still growing. And we shall see the result when the full year is out for Google. As for the revenue side, they have been increasing year on year since 2014 to 2021, despite there is an estimation that the earnings per share for Google will drop, but their revenue will still continue to grow. And do take note, Google does not pay any dividends, and also there is no information whether it is going to pay in future or not. So when you invest in Google, the main objective is only look for capital appreciation. Similar to Microsoft, Google have underperformed S&P this year, where they are down close to 30%, which is 29.76%. If you are holding Google for the past 5 years, you'll make about 100% returns, which is lesser than what you make from Apple and Microsoft. But nevertheless, it is still a very impressive returns at current market juncture. The fourth company in my portfolio is a giant in the healthcare industry, which is Johnson&Johnson. It also have a nickname called Dividend King. Johnson&Johnson have a market cap of 434 billion, where their gross margin is 68%, but their net margin is 22%. Their PE ratio currently is 22.98%, and their dividend yield based on the 22nd October closing price is 2.65%. The earnings for Johnson&Johnson have been increasing since 2014 to 2021, and there is no drop in it. Even the analysts have even forecast that their earnings will continue to grow for the next few years. From here, you can see that actually Johnson&Johnson is more like a more predictable company, where they don't really give surprise in their earnings or revenue. You see they are more or less on par with what analysts have estimated. Let's look at their dividend. It's increasing year on year from 2015, and it have been increasing for a decade without dropping. Their dividend per share is 2.95 cents at 2015 and have increased to 4.19 cents at 2021. However, their payout ratio is on the higher side compared to Apple and even Microsoft, where their dividend payout ratio is more than 50%. And let's look at their share price performance. Johnson&Johnson, they have actually outperformed S&P 500 where year to date, Johnson&Johnson, the share price is flat, where S&P 500 have dropped quite drastically. However, if you hold Johnson&Johnson for 5 years, you only make 18.7% returns. As you can see that it is a pretty boring stock that it just slowly grow up. And if you to add in the dividend, you can see that actually your return double to become 35%. So Johnson&Johnson, to some of them, will be more defensive in nature. And when you invest in Johnson&Johnson, most likely you are looking at the dividend growth of Johnson&Johnson. The fifth and sixth company are under the finance sector. The fifth company I'm going to talk about is called Visa, which is under the payment side, is finance category. We have a market cap of 387 billions. A gross profit margin of 76% is the highest among all the 10 companies in my portfolio, where their net margin is also the highest with a net margin of close to 50%. So it looks like their business is very lucrative and very profitable. Their P ratio is 28.22, but their dividend yield is very, very low at less than 1%. Visa have been actually hit by the pandemic, where you can see at 2020, their earnings EPS has dropped and also their revenue have dropped. But with the whole world start to reopen, analysts estimate their earnings for Visa will able to recover, pick up, and will go even higher. And in fact, 2021, their earnings already beat the pre-COVID level earnings. Visa dividend have actually increased by more than 100% over the past 6 to 7 years. It have increased from 0.48 cent to 1.28 cent. And their payout ratio is on the low side of around 20+%, which means that if they want to increase their dividend, there is a lot of room for them to do it. And let's look at the performance of Visa, which actually have outperformed the S&P 500, although it have down 12.48%. If you are holding Visa for the past 5 years, you will make about 76% profits. With the dividend included, you will just slightly better by another 5% more as their dividend is quite low. The sixth company is under the finance sector and it's a bank which is called JPMorgan, JPM, where it's a global financial services firm. We have more than 2.6 trillion in asset worldwide, and it have more than 200 years history. The market cap for JPMorgan is 340 billions. Their net margin is 38%. Their price to book is 1.33. For banks, we will more focus on their price to book. Their P ratio is 9.8. Their dividend yield is one of the highest among the 10 stocks that I'm holding, is at 3.44%. JPMorgan have also been affected quite badly by the pandemic, where their earnings have dropped more than 10% from 2019 at 10.72 to 8.88. Nevertheless, they have recovered to 15.38. However, for 2022, their earnings were expected to drop again, but after they were able to recover on that. With the result announced by the bank recently, they seem to be quite positive. But with the interest rate increasing, would the bank really benefit from it? We shall see in the next few quarters their bank earnings result. JPMorgan is also positioned as a dividend growth stock, where you can see that their dividend have increased by more than 100% from 1.72 to 3.8 over the past 6 to 7 years. And also their current dividend of more than 3%. It is one of the highest among the 10 stocks that I hold. But do take note their payout ratio is not stable as they try to increase their dividend on an annual basis. However, their revenue actually being affected by the COVID, which you can see that their payout ratio have increased to 40% for the year 2020 because their earnings have dropped. Year to date, JPMorgan had dropped about 23.54%, which is slightly worse off than S&P 500. If you are to hold JPMorgan over the past 5 years, you will only make 22%. However, if you add in the dividend, you make an additional more than 10%, where your total return will be 41.99%. The next company in my portfolio is a consumer defensive counter, is Costco, which is a discount store where they have more than 800 locations worldwide. The market cap for Costco is 205 million. Their gross profit margin is 12.1%, and we can see that their net margin actually is very, very low at 2.57%. Their main profit are mainly from the membership fee they charge to member rather than the products they sell off, as their margin is very, very low. Their P ratio is 35.36 and their dividend yield is less than 1%. And Costco was not affected, and in fact they have benefit from the pandemic, where you can see that their EPS had grown from 5.24 in 2015 to 14 in 2022, where their EPS have increased by way more than 150%. Similarly, their revenue have almost doubled. It's also a dividend increasing stocks. And one thing unique about Costco is every around 4 years, they'll give a one-off special dividends on top of increasing dividend on a year-on-year basis. We can see that at 2016, they got 1.7 cents. At 2017, it become 8.9 cents as they give them a one-off dividends. After that, their annual dividend will continue to increase. At 2021, they give another one-off special dividends. So the next special dividends may happen maybe in the 3 years later. So a lot of investors, when they invest for Costco, are not only on their increasing dividend, they're also looking forward for their special dividend every few years. Let's look at year-to-date performance. Costco share price, you have down about 15.37%. You have held Costco for 5 years, you have made close to 200% returns, which is double the return of what you hold on Google, and the return is almost on par with Microsoft. And if you were to add in their dividends, you'll get another 20% more, which is 218% returns for Costco. And do take note, this stock is classified under consumer defensive sector. Now, number 8 stock in my portfolio, it is called Disney, which is a place that I want to bring my children there. Their market cap is 179 billion. Their gross margin is 25.61, but their net margin is 3%, as they have been badly affected by the COVID, where all the theme parks are closed, and now we are on a reopening phase. They are still able to make some profit. Also, one of the key reasons because of their streaming business with the Disney Plus. Their P ratio is 57.29. In fact, it's the highest among all the 10 US stocks I'm currently holding. Their earnings have been increasing year on year before the COVID, and when the COVID comes, we can see that they are being hit pretty badly. And despite their revenue have managed to able to maintain. Furthermore, they have stopped paying dividend during the COVID period to conserve more cash so that they have more money to invest and grow during the COVID period. So a lot of people, when they invest for Disney, they're also looking for dividend, and it was supposed to be a dividend growth stocks. But the COVID come and it got hit quite badly, and they have stopped even paying dividends. Whether they'll resume their dividend payout going forward is something that is still not very clear yet. The share price for Disney have been greatly underperformed the S&P 500 year to date, where they have down more than 34.52%. And you have to hold Disney for 5 years, practically it is flat. You only make a 3% profit. If you have to add in a dividend, it is just slightly better of 8.33 if they have stopped their dividend during the COVID period. So whether can Disney recover, we will see how is their theme park and their merchandise perform at the post-COVID level. And we also want to see how their streaming business, Disney Plus, have been performing. The second last company in my US portfolio is Nike, which is a footwear and apparel company. We have a market cap of 135 billions, where their gross margin is 46%, but their net margin is only about 13%. Their P ratio is 24.66. Their trailing 12-month dividend is 1.41%. Nike have also been affected by the COVID, where you can see that earnings will have dropped to 1.6 cents per share. It is even lower than 2014 levels. However, they have started to pick up after that. But now they are facing some inventory issues where they have oversupplies of inventory, where they need to clear the inventory and they may need to slash price to sell off the inventory, and this may affect their earnings per shares in the coming financial years, which explains why their share price have plunged recently. Their revenue have been increasing steadily, and there's only a slight dip in 2019, but the costs have go up, and which resulted in a much lower earnings. One consideration about Nike is that it is also a dividend growth stocks, where their dividend have grown by close to 100% from 2015 to 2021. However, do take note that their payout ratio is not stable, as their earnings have been fluctuating. Despite that, they still got a lot of buffer to continue to increase their dividends, as currently their payout ratio is 31%, which is still have a lot of rooms for them to increase their dividend going forward. Nike share price have plunged close to 50% year to date among all the 10 stocks that I currently hold on the US portfolio. However, if you hold Nike for the past 5 years, you are making 66%. You are still in the black. Plus the dividend, you make about 75%. The last counter that I have in my US portfolio is a REIT. It's called Realty Income. It is a money-driven company, which means that this counter pay dividend every month without fear, and it have increased dividend 117 times since it's listed in 1994. The dividend is supported by the cash flow from the property they own, which is more than 11,000 commercial properties. The market cap of this REIT is 35 billion. It is relatively small compared with the other 9 US stocks that are currently holding, but it has the highest dividend yield, which is 5.14%. And the price to book ratio is still trading at a premium of 1.35 despite interest rate is increasing, where we expect REIT share price to drop, but you are still currently able to trade at a premium. I would say that the earning is pretty stable as it is a REIT, but they need to pay out at least 90% of their income out as dividends, and their revenues have been increasing year on year. Their dividends steadily increase every year, where they have been increasing their dividend for decades and not dropping. With the current market performance, this make the dividend yield even more attractive, which is more than 5%. These REITs have dropped close to 20%, with the main job come actually in September, where there's a big market sell down, where it have plunged more than 20% from its peak down, and now it seems to be trading sideways. If you were to hold these REITs for 5 years, you only make a profit of 6.73% in capital gain. However, if you were to include your dividends, you make a 32%. So the main objective when you invest in this counter, you are more looking at the dividends rather than the capital upside, where you can see that the capital upside is not really that great. Even before the drop, it only gives you about 40% upside over 5 years. However, do take note for Singapore investor, when you invest in the US stocks, there is a 30% withholding tax you need to pay for dividends. There's no capital gain tax, but there's a 30% withholding tax. So whatever dividend you collected, you need to discount it off by 30%. So this is one thing to think note if you are looking to invest in US stocks for dividends, which is why most investors invest on US counter, they are looking for the capital gain. But if you were to invest in the dividend growth stocks, you see the capital gain will follow, because the company is making more and more money and paying out more and more dividends, and this will indirectly have a positive impact on the share price upside. Now let's look at a comparison of these 10 US stocks that I currently hold. Apple and Microsoft belong to the technology sector. Google is under the communication services. Johnson&Johnson is healthcare. And I got 2 finance stocks. One is Visa and JPMorgan, but one is belong to the banks category, and one is called the credit services. Costco is a consumer defensive. In fact, they have been holding very well and performed very well over the past 5 years. Disney, under communication services, is mainly on entertainment. And Nike, footwear and accessories, is also the consumer category. And Realty Income is real estate, which is a REIT. This is the 10 US stocks that I currently hold, and all are inside the S&P 500. And of all these 10 stocks, 6 are listed in New York Stock Exchange and 4 are listed in the NASDAQ. So let's do a comparison of the 6 stocks that is listed on the New York Stock Exchange and compare with S&P 500, where we look at SPX, which is S&P 500. Year to date is down more than 20%, where we can see that there's 3 stocks actually outperform them. One is the J&J, Visa, and Realty. But another 3 of my stocks underperform the S&P, which is the JPMorgan, Disney, and Nike. Let's look at the other 4 stocks that are listed in NASDAQ, and we compare with S&P and also the NASDAQ composite. The NASDAQ composite have down 31%. So these 4 stocks actually have performed better than NASDAQ in a way, and they are down lesser. And on top of that, Apple and Costco actually have outperformed SPX, but Microsoft and Google actually have performed worse off than the market when we compare to SPX. This is from Finviz, where we can see the sector map, year-to-date performance. Practically, you can see majority of the stocks in S&P 500 are in the red, and this also explains why my portfolio currently is in the red also, where all the counter I hold, none of them is in the green sector. This is a summary of the 10 counter, where, as I mentioned in the start, that currently my Costco and Visa is making slight profits, and the rest are currently in a loss. Portfolio US stocks loss in Sing dollar equivalent is about 1,002, and currently I still have slightly less than 30% cash in my holding. And every 2 weeks, I'll top up 2,000 into my portfolio until the portfolio reach 50,000 by the end of this year. I'll still continue to invest, and also I may sell off some of the stocks if there is a strong rebound and I make some profit on that. However, I will still stick to 10 US stocks in the portfolio. So if I were to remove one counter from it, I will need to replace it with another US stocks. And I also will maintain at least 20% cash balance at this juncture until the end of the year. I will continue to stay invested, but at the same time, I will still hold cash to wait for opportunity. And also when there is a good profit on the individual counter, I will trim the holding along the way also. And that's all I have to share with you today on my 10 US stocks. I'll do a separate video sometime later to talk about the 10 Singapore stocks that I'm currently holding. So do watch out for it. If you feel that you have benefit from this video, do remember to like, share, and also leave your comment below to let me know what you think. And lastly, do remember to subscribe and press the notification button so that you'll be notified on my next video. I shall see you in my next video. Bye bye.